Hi, good afternoon, guys. So when the mountain doesn't come to Muhammad, Muhammad comes to the mountain. So let me come closer to you guys. So it's always a difficult task to come after lunch, isn't it?
Difficult as to sit in the first bench.
So that's why look at me coming closer to you guys now. Okay, so lovely having you all. So my name is Anand. In my previous life, I was an investment banker come real estate professional. So came back to India early 21, late 21, we raised a little bit of capital and we set the ball rolling, so to speak. So we are trying to make real estate into an exchange traded OTC product, which means we will help people buy, sell real estate 1 square foot at a time, like how you buy shares, So you can buy 1 square foot of this hotel, if that's the case maybe. So whether it's hotels, we have a very horizontal spread of assets right across hotels, retirement homes, hostels, schools, warehousing, office assets, So the concept stems from what we call as tokenization of assets. I'm sure concept is largely familiar. So let me start by asking a few questions. How many of you are hotel owners here? Oh, bunch of you all, great. Almost all of you all. And managers, operators? Okay. Hotel managers come operator, cool. So let me ask you guys a quick few questions, So today, when you guys are building up a hotel or refurbishing, what's your cost of capital when you avail debt markets? Indicative cost of capital. For construction finance? 8.5%, 9%? Sorry? Depending on your rating, yeah, I mean, coming from a banking perspective, ranges anywhere between 9.5 to 13-14%, right? That's broadly the range for construction finance. How many of you have access to equity in your assets? Equity is scarce, unless it's FDI to some extent. Very, very, very little equity is available in operating assets in India. But do you guys know what's the cost of equity that you guys do? Do you guys give preferred returns and things like that? Would you guys care to just give me some numbers on what is the cost of capital for equity? 15, possibly at the low end. Mostly, yeah, rupee. Not the 15. It's usually about 20-22%, right? That's the kind of capital. And if you want to build in hotels which are viable, what's the ideal cost and what's the ideal tenor of this instrument that you would like? Meaning, if somebody is giving you money, equity is perpetual. He gives you money and then, you give him returns thereafter. If it's debt, what's the ideal tenor during which you'd like to hold the capital, farm it into your business, and then try and return it back? What's the ideal kind of capital? What's the ideal kind of tenor? Sorry? 10 years. Any other guesses? Any other requirements? 7 to 10 years, yeah. So, 15 years, right? Very interestingly, the ideal requirement of capital is very different from the actual terms of capital that is available, isn't it? We all want equity or equity-like money, which is near perpetuity, but we don't want to pay 22% return because the underlying business does not support 22% kind of return. So we want debt-like money. That's what tokenization does to asset owners. Tokenizing your asset provides equity-like money. It's perpetual in nature, like equity, or what we call as near perpetuity, 25 years, 30 years kind of tenor. But the requirement for returns are 10%. And this 10 to 12% could be a combination of annuity yields plus the long-term appreciation of capital, which means your annuity returns that you need to provide, like interest, could be as low as 9.5%. So you get equity-like money, 25-year money at 9.5%. It's kind of a dream, isn't it? You can't get that from institutional capital, right? So this capital comes from retail. So to get this kind of capital, we need to offer safety, So which means we offer real estate based assets so that we tell the guy, hey, listen, your capital is safe. right? We say, hey, listen, you're owning the underlying real estate, you're owning the underlying hotel, you're owning the underlying school. So the capital is safe, and because the capital that you offer is, or because you render safety to the provider of capital, the provider expects only 9.5% kind of return. Now the requirement of this is you need to have patience to raise this capital. This capital doesn't come from one guy writing a check. So you go to a banker, you go to an equity provider, he gives one check and says, hey, listen, this is what it is, but then the terms are not what you want, but then because there's nothing else available, you take that capital. But if you're patient, then you can tokenize your assets and raise capital in the kind of terms that I just told you about. So with that context in mind, let me just give you what we are doing. We are setting up the world's first real estate exchange, just like how there's a national stock exchange for equities. Then somebody said, hey, listen, commodity should not be done in agri-mandis anymore. So MCX and NCDEX came in. Okay. Real estate, for some strange reason, Christ has come and gone, but we're still doing business the same way as it was done during those days. So we are trying to see if real estate can be made into an exchange-traded OTC product, which means everybody would be able to buy and sell 1 square foot at a time. Any asset of their choice, 1 square foot at a time. It happens like how you buy units of REITs. Units of REITs are very similar. So there's no transfer of property, but you buy the cash flow rights. So that's what we are trying to do. In the next 7 to 10 years, across the world, very large real estate exchanges would emerge. Very large real estate exchanges emerge, which will compete in size and scale to the likes of an NASDAQ or an NYSE or our own homegrown NSE. So we are giving a shot at that. Why are we doing that? If you have an exchange, you would be able to raise capital. It's essential for somebody who gives you, let's assume, $100 as capital, gives you $100 for near perpetuity, 25 years, and says, okay, I'm all right to take 9.5%, 10% return, which means you need to offer him liquidity, because you're not going to return the capital, okay? Because that's not part of the terms, right? Which means there needs to be a secondary market where if he needs his money back, he is able to sell his instruments, right? He doesn't come back to you asking for money. He gave you money, he doesn't come back to you like a lender would asking for money, but he would be like an equity holder going to the markets and selling his investments down. So for us to be able to provide you hotel owners access to this kind of capital, it's important for us to build an exchange. So that's why we're building the exchange. So we are people who bring in providers of assets, providers of capital together, So we bring in asset owners, we tell them patience is required to raise this kind of capital, and we bring in providers of capital, and we tell the providers of capital, offer it at these terms, and if you want liquidity, you get your instruments out, you can do secondary sale of instruments. And to do this, it's very important to write an algorithm that prices real estate. Just like how a security would price if you buy a share of Apple or share of Infosys, the real-time value of the shares, right? So very similarly, if they put into your Goa asset or Goa hotel, 5 years, he put in, let's assume, 2 million Indian rupees into that asset, and when he wants to exit 6 years later, he needs to be able to figure out what is the net asset value of my 20 million that I gave, and he would, let's assume that 20 million is broken up into, theoretically speaking, 200 square foot in real estate terms. He pays 20 lakhs, gets 200 square foot equivalent rights in your property. He gets rights of 200 square foot equivalent in your property. And when they want to sell, they should be able to theoretically sell 1 square foot at a time. Just like how you put in 20 lakhs into an Apple share, and when it's time for you to sell, you can sell 1 share at a time. You can buy 200 shares of Infosys, and when you want to sell, you can sell 1 share at a time. That's what tokenization of real estate does. So this is me and Avinash got together. I'm like half a banker, half a real estate person. Avinash is half telecom, half real estate. But other than us, it's a whole bunch of very senior asset managers who are in our platform. Prashant is an ex-hotelier. He built a very interesting boutique hotel called Mango Hotels Interly Stays, if you guys have heard, and sold it to Sayaji Hotels. He's a co-founder in our platform, runs the hospitality assets. So we have asset managers for schools, land, retail, various kind of assets, because capital is agnostic. capital wants to invest in real estate, whether it's a hotel or whether it's a school, it doesn't matter to them, the kind of assets somebody might like a hotel in Bangalore as against a school in Coimbatore, So capital is also very location specific because I understand Coimbatore, let my money be parked in a Coimbatore asset so that when I take my bike and go by, I can see that asset every day, So this is very location specific capital that comes in. So we have a great bunch of asset managers who come in. So to those of you who are hotel owners, broadly what we offer is this, either complete exits, which means there are people amongst us who are constantly looking at exits and there is this constant squabble for valuations, right? Let me give you a classical example. Let's say an asset which is $100 in value, or let me put it this way. Let's say the asset generates 8 rupees of operating distributable profits. Let's say one of your hotel is distributing 8 rupees of distributable profits. What's its value? If it's distributing 8 rupees of annual profits, by cap rate, let's assume 8% is the cap rate, the value of the asset is $100. So which means people are willing to pay you $100 for your asset and willing to take 8 rupees as profit distribution, which means they're happy with 8%. Then hopefully the real estate will grow in value, it will generate another 5-6% return. They're very happy with 10-12% return. The problem is, you as asset owners would say, but the underlying real estate is $200 in value. Or maybe the cost of you buying land, putting the hotel together is possibly $200 in value. But the asset is generating only $8 in capital. So the value of the asset, is it 100 or is it 200? Most often, institutional capital walks away, or either institutional capital walks away or you guys walk away. Institutional capital gives you $100 because this is exactly how they will value the asset. You guys will say, listen, residential right next to my asset is going at $200. Why should my asset, it's taken me much more cost to put the asset together. Why would my asset be sold at $100? Tokenization of assets give you flexibility in segregating real estate ownership from cash flow. Let me tell that again. So you want 200 rupees for your asset, right? Yeah? Are you guys with me? And it's generating only 8 rupees of distributable profits. You can sell 100% of your cash flow distribution to the investor and 50% of your hotel real estate ownership. Let me qualify that again. Somebody comes and gives you $100. He buys 50% of your real estate. You valued your real estate at 200 rupees, correct? So somebody comes and gives you $100, he buys 50% of your real estate. But he owns 100% of the cash flow, up to $8. So which means it gives you time to take that $100, retire your debt, upgrade your hotel, do whatever that is required. Maybe start another hotel if that's required. Gives you that extra time because there's no pressure on cash flow, because there's no EMIs to pay, because it's equity like money. You've taken your $100. Now, you can do this if you believe that your asset can actually generate, instead of 8, $15. But then to get to 15 might take another 3 years, might take another 4 years for your asset to stabilize. So you take your $100, sell 50% of the real estate, but cash flows up to 8 rupees goes to the guy who gave you $100. So the guy who gave you $100 is very happy because he gets 108% returns. You still have 50% control on the real estate, which means any cash flow, any asset improvement that you do that helps you generate cash flows beyond 8, the asset becomes $12 in profit generation, the $4 comes to you. It generates 15 rupees in profit, the $7 come to you.
Cap the return of the 50% buyer at 8 rupees?
By and large, I mean.
But then that buyer won't be interested any longer because his returns are capped.
Yeah, I mean, without peeling the onion too much, the 8 would grow up in value. Okay, 8 would grow up by a nominal 5-6% every year. Okay, so your cash flows need to grow faster. If your 8 can actually grow to 15 in 3-4 years, makes great sense, right? So, but then you need to have confidence that your asset can generate that. So that's the way tokenization of assets can claim, because you can segregate the cash flow from the ownership of real estate. That's what tokenization does, So it can hence be strategic full sale of asset, partial sale of assets, instead of replacing debt with tokenized capital. All these are possibilities. And the beauty of this is there is only one entity that you deal with. Tokenization of assets means I get 100 people to give me, let's say, $1 each, theoretically speaking, $100 to give me $1 each. The capital gets pooled into a single entity. And that single entity comes onto the cap table. Okay. So you have no business dealing with those 100 people who have given you $1 each. All those people who have given $1 each have appointed Alt as their representative, as a manager, as an owner's representative. And hence you'd have a Prashant, who's a hotelier, sitting with you, because now we have interest, we have 50% owner of the asset. Can we help in any way to improve the assets? So that's how this business works. Today there is no licensing law in India to run a real estate exchange. But just because there's no licensing law does not mean it's Wild West. There are over 26 rules that are applicable to our rights, from P2P lending guidelines, fund licensing norms, FEMA. We have to be in compliance with various capital. For example, what we do right now is a closed user group asset, which means if, let's say, you put in 10 million Indian rupees into an asset, you get, say, 100 square foot, which means these are not actual physical square foot, it's 100 square foot of rights that you have. You can't sell those assets to your Chinese friend or a Russian friend. It's a closed user. Meaning this business is only for Indian assets. Investors can only come in if they have an Indian bank account, PAN number, Aadhaar. So hence to that effect, I can't attract global capital because of FEMA rules and things like that. But then Indian capital is sufficiently large enough for us to attract, because traditionally Indian capital who wants to put in, let's assume, 25 lakhs. What investment choices do they have if they have to buy 20? You can't get a one-bedroom apartment. As hotel owners, you all have known fractional real estate as a model where you sell one key to one person, right? So key number one is, you've built a 100 key hotel. You built a 100 key hotel. Key 1 आपका है, key 2 आपका है, and sale deed is registered in your name. You're the owner of the key. And then they all lease it back. Okay? Which means as a hotel operator, you now need to deal with 100 owners. Okay? So what means the traditional fractional real estate destroys the integrity of the asset. Now suddenly you have 100 owners, each one having varied requirements. Some of them could be nonsensical, and you have to deal with them. So fractional is a very poor cousin of tokenization of real estate. Tokenization of real estate formalizes the way in which capital comes into your asset. Finally, there's only one entity that comes in. That one entity has an informed banker-like person who deals with you. That's the way it's different.
You tokenize the shares of the SPV, or you tokenize the underlying property in terms of the token holders have the underlying right to sell their 1 square foot. What are you tokenizing?
So let's take this classical example. Let's say it's a 100,000 square foot Hyatt hotel. We set up an SPV. Let's say it's 100 crores in value. Now the SPV needs to raise 100 crores in order to buy this asset. Let's assume it's a complete sale for simple. It needs to raise 100 crores to buy this capital. So it would raise capital in 2 instruments, equity instruments. Okay, that's one instrument. The equity instrument, it will raise only 20 crores in value. Remaining 80 crores, we will write what is called as cash flow documents, which is whatever cash flow that this underlying real estate generates, rent, operating profit, okay, all that is written into terminal cash flow. Whenever the real estate is sold 25 years later, whatever is its terminal cash flow, all that is written into this contract. Now the number of contracts that we write is equal to the size of the asset. So which means if it's a 50,000 square foot asset, number of contracts we write is 50,000. So hence if you buy one contract, it's like buying the cash flow of one, the financial rights of 1 square foot is written into it. So when capital comes in, so let's say you put in 1 crore into that SPV, 20 lakhs goes into into buying equity instruments. The SPV sells equity instruments. So 20 crores is the paid up capital. You put 20 lakhs, so you get 1% of the SPV. Similarly, 80 lakhs of your investment will go into buying these cash flow documents. So you buy 1% of these cash. This is what is getting tokenized. This is what becomes tradable. So you buy 80 lakhs worth of contracts. So I've written 100,000 contracts. 1% of 100,000 is 1,000 contracts, 1,000 square foot. It gets credited into your demat account like wallet. Not demat account, demat account like wallet. Now suddenly, you put in 1 crore, you have 1,000 square foot. Theoretically, when it's time for you to sell, you can sell 1 square foot at a time. That's what we do.
Questions aside, please, the next session has to start now. So whatever questions you have, Anand will be outside the room. Please ask him more than one.
Yep, that's, well, thank you. Any of you wants to sell assets, we are the guys to talk to. All right, cheers.